In this video we are going to talk about get started in stock splits. So before starting, please like this video and subscribe to this channel for our future updates. Whenever you were a kid and you had to split something, it didn't necessarily feel like an added bonus. If you're an investor, on the other hand, it's possible that sharing your money is a good thing. It is possible to split a company's stock in order to make it more accessible to smaller investors. This is particularly true when the stock's price has increased to unaffordable levels over a period of time. Let me give you an example from recent times. A 4-for-1 stock split was announced by Apple on July 30th in an attempt to bring the company's stock price back to about $100 per share. While a stock split has no effect on the value of the company or the value of your investment, it is important to understand how stock splits might affect your overall investment portfolio and the value of your investment. Here is everything you need to know about the current scenario. What is a stock split? The board of directors of a corporation can use stock splits to increase the number of shares in circulation while simultaneously decreasing the price of the company's shares in circulation. The announcement of a stock split is frequently preceded with ambiguous arithmetic, such as 2-for-1 or 3-for-2, which might be difficult to understand. Pizza, like so many other things in life, has the potential to be useful in certain circumstances. Let us consider the concept of a company's worth being symbolized by a fully stuffed pizza crust. That pizza was cut into a limited number of pieces, or shares, when the company's stock first went on the market, and those pieces, or shares, were subsequently made available for purchase by investors. Consider for the sake of argument that the pizza was cut into 8 slices and that you each received 1 slice of the pie in question. The announcement of a 2-for-1 stock split results in a more than twofold increase in the number of shares in the company, resulting in the original pie being divided into 16 slices. Before the split, you owned 1/8 of the company. Now, as a result of the split, you own 2/15 of the company. The total amount of the pizza remains the same, but the number of slices is vary from one another. Any split ratio, no matter how high or low, follows the same general idea. For example, the most recent stock split from Apple was a 7-for-1 split in 2014. Do you have a hankering to learn more? Take a look at some other stock market fundamentals. Another type of stock split is the reverse stock split, which works in the opposite direction of the traditional stock split in that the number of shares is reduced while the price per share rises, as the name suggests. This is frequently done in order to achieve the minimum stock price requirement for a firm to be listed on a stock exchange. What happens when a stock splits? An increase in the value of a company's stock does not result in a windfall for investors. In practice, a stock split has no effect on a company's market capitalization, which is equal to the number of shares outstanding multiplied by the price per share, and is calculated as follows. Increases in the number of shares will result in a rise in the share price that is equal to the increase in the number of shares issued. As a result of a 2-for-1 stock split, a stock that was formerly valued at $100 will now be valued at $50. Despite the fact that you now hold more shares, they are all worth less than they were previously. In the end, it's a dead heat, and the value of your investment will remain unchanged as a result of this outcome. Stock split announcements, on the other hand, are frequently received with enthusiasm by investors, in part because they signal that a company's board of directors aims to tempt investors by making the stock price more affordable while simultaneously increasing the number of available shares. It is possible that your portfolio will see a big boost in value as a result, if the stock's value continues to improve in the future. In studies, it has been demonstrated that stocks that have split have outperformed the broader market in the year immediately following the split as well as during the next few years. How to take advantage of a stock split? In order to be eligible for a split, a shareholder's position must have been held by the corporation by a specific date specified by the corporation. It is recommended that you undertake extensive research on a company before investing in its shares after it has experienced a stock split to ensure that it is a solid investment for your portfolio before making a decision to invest. How does a stock split impact your holdings/portfolio? To be successful in investing, you must understand that a stock split, including a reverse stock split, has no effect on the proportional ownership of your position and that the market will determine the impact on the total value of your investment. Understanding this is critical to your investment success. Even though your total number of shares changes as a result of a stock split, the stock split itself has no impact on the value of your investment. Let us consider the following scenario. You own 100 shares of a company whose stock is now trading at $200 a share, for a total market value of $20,000 in the company. You would own 200 shares of the company at $100 per share after the stock split if everything else remained the same, for a total value of $20,000, the same as before the split, assuming that nothing else changed. Investing implications. Some investors believe that a forward stock split is a signal from management to investors that the company believes the stock's value is appealing, which is supported by the data. Furthermore, the dominant view holds that the stock will become more available to additional investors at a lower price as a result of the price reduction. It is possible that the stock price of a company will rise quickly following the announcement of a stock split, due to this management signaling effect. In the short run, there is some evidence that companies that split their stock outperform the broad market. Of course, this does not imply that a stock would gain in value following the announcement of a stock split or when the split takes effect. Keep in mind that a stock split in and of itself has no effect on the value of your holdings. If the company does not experience good earnings or dividend growth following the stock split announcement, any gains gained by the stock following the stock split announcement will most likely be wiped out, and the price will fall back to, or below, its pre-split announcement level. When a firm decides to split its stock, it will usually announce the split many weeks before it really happens. As a result, there is a period of time between the announcement and the stock split that must be observed. You would not want to make a choice to buy, or sell, a stock purely on the basis of a stock split, would you? Due to the fact that the fundamentals and growth prospects of the underlying company are not altered, a stock split has no effect on the value of the underlying shares. Having determined that you wish to purchase stock in a firm that has announced a split, the timing of your purchase might be dictated by your research, objectives, risk restrictions, and any other variables that are relevant to your plan. Other management actions involving the company's shares, such as changes to the dividend payment schedule or the introduction of a new stock offering, have repercussions for the company's fundamentals and, consequently, the value of your investment. A stock split, on the other hand, does not. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.